Well, hello everybody. This is Ken Himmler and welcome to another edition of the Wiser Money Show. However, today is going to be a little bit different than normal. Normally, I go through economic indicators, I go through inflation, interest rates, tax changes, a lot of different things. I am going to focus a little bit more on educating you in each of the areas that I'm talking about. Now, it's funny because when I started writing today's show, I thought, well, I can talk about dusting off annuities because now in these economic times with caps going up, as you know, I have not been fond of annuities since 2015. So almost 7 years, I have recommended that people be very, very careful with what they're doing. Now, annuity salesmen would always dispute my advice, but now that the S&P has dropped and caps are up, interest rates are up, there are some opportunities. I was also going to talk about what I call the drip skip, which I did talk about last week. I was going to get into that a little bit more. And I was also going to talk about some of the tax changes that are coming up and end of year tax planning. So I started writing today's show and I thought to myself, oh my gosh, if I really do this in depth to help educate people, I'll be sitting here for 3 hours. You're going to fall asleep. Your head's going to hit the desk. You're going to get a bruise on your forehead or get knocked out, and it's going to be my fault. So I'm going to stick to something small, chewable, editable, like they say, how to eat an elephant, one bite at a time. So today, I'm just going to concentrate on the buckets. Then what I'm going to do is I'm going to do another show for next week, and it's going to talk about dusting off the annuities, what to look for, how to beware of the annuity salesperson, how to do deep dive research in the public domains that are available. We pay for a software, but I'm going to show you how to do it. And then the final thing is I'm going to show you, make sure you understand what things you need to do before the end of the year for tax planning. And here we go with today on the buckets. So many of you know that I have been teaching this and using this system for, 35 years, or 38 years now, almost 40 years. And every economic upturn, people want to go with the trend. Every economic downturn, people want to go with the trend. So today, all I'm going to do is I'm going to teach the basics. Now, when I do this in public domain, meaning if I'm out teaching this at an event, I don't have the time, nor do I have the ability to actually show in detail what I'm going to show you today. So today is kind of a sweet surprise because as I built this out, I thought to myself, I wish in those years that I was doing those public events, I wish I was able to teach this in its own granularity, as I'm going to show you today. Okay, let's start off. It's important to understand why we use the buckets. Here's the perfect example. If we look at the year-to-date history on the S&P 500, we're sitting at a negative 24% year-to-date. If we go back 1 year, a whole 1 year, not just year-to-date, it's only down 15%. Now, if I go 5 years, actually 5 years, I'm still up 42%. Now, if you do the numbers, you're sitting somewhere at 6.5% or somewhere around there. So if you look at the buckets and how they are designed, they're designed to follow accumulation or distribution strategies. You can't be in both. It's like driving on one side of the road. You can't drive in the middle of the road. You got to decide, are you in the accumulation phase or the distribution phase? That should be pretty evident what those two mean. Now, I'm going to show you the three buckets, and they're designed based upon the measurable volatility. You're going to hear me use, and you probably have for years, VMS, volatility measured segmentation. Big word for basically meaning that what we're going to do is we're just going to combine different volatilities that are assigned to different asset classes. So let's look at this. In a 1 to 5 year bucket, you have things like short-term bonds, money markets, TIPS, and I-bonds. Now, there is some legislation on I-bonds that's about to hopefully be passed, and that may change the way that I-bonds are issued to multiple parties versus one single party. But if we look at what does that mean in the volatility? There's virtually no volatility in any of those, right? The problem with the 1 to 5 year bucket, you will never beat inflation. I'll state that again. You will lose against inflation. This is why we only put a certain amount in that bucket that accounts for 5 years worth of your cash flow. So if somebody said, I need 20 grand, if I looked at it and said they need $80,000 a year to live on, they have $60,000 in pension and Social Security, they're short by 20. If they have $1 million, what I know I have to account for is, what do I have to carve out of that 1 million to put into bucket 1 to provide them with $20,000 a year for 5 years? You know the answer, it's $100,000. Now I'm left with $900,000. If I know and I account for inflation, even at the higher rate, how much will I have to provide for them in, say, 5 years? Probably $130,000. So in capital that comes out of that million. Right now I only have $900,000 left. So that puts me at about $770,000. In this particular case, out of $1 million, because I only need 20 grand a year, I can put $770,000 in bucket 3. Now, some people might say, yes, but I don't want the volatility, I don't want the risk, I don't want this, I don't want that. Listen, if you can allocate something for 10 years, your risk of loss, if it's properly diversified and allocated, is next to nil. It's set somewhere between 1 to 5% in the chance that it would be down after 10 years, if it's allocated correctly. Now, I'm not talking to go out and buy IPOs or Google or, what you think is the next, rare earth metal or EV battery company. I'm not suggesting that in any way, shape, or form, because that's security selection. And I'm not suggesting that you mark a time. You wait until the right time to get into bucket 10. That's less than a 1% chance of actually making it work. Reverse engineer your cash flow. Now, if you're in the accumulation phase, I'm going to show you how to do this in just a second. Now, if I move into bucket number 2, you'll see immediate bonds, some long-term bonds, but they have to meet some of the criteria. Preferred stock, convertible stock, and some dividend stocks. Now, when I say dividend stocks, I'm talking about old blue chips that have what Warren Buffett refers to as a toll bridge. If you don't know what that means, read Buffettology or read any book on Buffett. And he'll state a toll bridge is something somebody always has to cross to get somewhere else. It could be a contained utility company. It could be a contained system where somebody needs something all the time. He also talks about that renewable income. Paper towels, toilet paper, toothpaste, companies that sell things that people have to replace. And those can be put into segmentations. But the point is, they'll have some volatility, and I'm going to show you how much that is in a minute. But it's not like buying the general stock market. Now, if I move into bucket number 3, this is where we're going to see what I just showed you on that screen, that S&P 500 with a down 24% over a year to date, but still up 42% over 5 years. So let's take a look at this now as we get into the concept of this. If we allocate the right amount of money based upon a reversed engineered cash flow plan, we have a certain amount that we put into each bucket. What we do is we pay out the cash flow that's needed from bucket number 1 for 5 years. When bucket number 2 is still growing and bucket number 3 is still growing, we're not touching that. We're not using the dividends. We're not spending it down. We're not selling it, right? We're not selling into markets. Now, what will happen is when bucket number 1 runs out, bucket number 2 has grown for 5 years. When bucket number 1 runs out, bucket number 2 steps into play, and it starts to make distributions between years 5 and 10. Remember, we're still not touching bucket number 3. What we're doing is we're letting that sit there and grow. So when bucket number 1 has run out, bucket number 2 has run out, guess what? All we do is we replace it with bucket number 3. It steps into the beginning position, and then we reallocate it again based upon the cash flows. Now, some of you that have studied me for a while, I talk about the bell curve as opposed to the linear planning. 99% of the world plans for cash flows linearly, and that is coming from a lot of places. The College for Financial Planning is one, But it says, hey, I'm going to project my income all the way out to age 100. Well, bottom line is, after almost 40 years of doing this, I have found that people don't spend the same thing. Once they're over 80 years old, the spending actually goes down. Medical goes up, everything else goes down. Travel goes down, replacement of cars goes down. Even a lot of times housing goes down because they don't need that big 2-story house, they move down. So now what I'm going to do is go through with you the concept of what happens in the accumulation stage. Now remember, I'm referring to you are still working, you're still saving money, and you're trying to accumulate money. The first thing you should do is put as much as you can into bucket number 3. That's the 10 plus bucket. And as you're growing your money, keep a small emergency fund, not a lot, but put as much as you can into bucket number 3. Then 5 years from retirement is when you need to start shifting this. When you get into retirement, which is your distribution phase, that is when you start to rebucketize. I know it's a weird word, probably not anywhere in any dictionary, but you're going to rebucketize, which means you're going to allocate the amount you need into bucket 1, which is the 1 to 5, what you're going to need from 5 to 10 years in bucket number 2, and leave the rest in bucket number 3. And when you distribute money, you do not take dividends from bucket 2 or 3. This is a big mistake. If you have a preferred stock paying you 7%, when you reinvest it, you're earning 7% on the income. I see people doing this all the time. They'll take the dividends out to spend, yet they got cash sitting in the bank earning 1, 3, 4%, nothing, right? It's not beating inflation. So again, there is a specific reason and methodology for this system. So again, 5 years prior to retirement is when you want to convert. Here's where we're going to get into the meat and nitty gritty. So I tried to leave as much time as I could because I want to explain this and I want to go slow. Hopefully not slow enough where you fall asleep, but hopefully slow enough where you absorb it. So we're going to take each bucket and we're going to break them down separately. I'm going to use 2 terms. One is rate of return, ROR. The second one is VMS. As you can see, that's volatility measured segmentation. Remember, if I look at an S&P 500 index fund, it's down 24%. If I look at a money market, it's not down 24%. It's not going to go down at all, but it's only going to pay about 2.5 to 3%. And when inflation is 8 or 9, I'm still losing money on that money market. If I look at a short-term bond, it might pay 4 to 4.5%, better than the money market, but it might have 1 or 2% volatility. Let me explain what I mean by that. If I look at each bucket, I can assign an average volatility based upon what's in that bucket, and I can go back and historically look at over those periods of time, if these buckets are allocated correctly, they are rebalanced correctly, then I have an estimated rate of return or a targeted rate of return. So in bucket 1, my targeted rate of return is only 3 to 5%. Again, that's today, and it's important to remember, I have no anticipation of the bucket number 1 ever beating inflation. If that's the case, and inflation's at 8.5 to 9%, you can see I'm losing money. That doesn't make sense to allocate a lot to that bucket. So again, each bucket not only has its anticipated rate of return, but it also has a volatility rating. That is the VMS rating. So in bucket 1, it's 1 to 2% up or down. And what I mean by that is, and I'll show you an example of this in a second, it means it's just going to fluctuate. It can go up by 2%, down by 2%. Now, it still could be paying a dividend, but its volatility off a baseline, its principal amount, is a couple percent up or down. Now, in bucket number 2, my anticipated or targeted volatility rating, VMS, is up or down between 5 to 10%. Now, when I move to bucket number 3, here's where we get the volatility. If you look, by the end of last year, 2021, the S&P, that bucket number 3, was up 23 to 25%. Right now, it's down 23 or 24%. So you're getting a perfect benchmark of how that third bucket works. Now, in order for us to figure out how to reverse engineer and manage money in a uniform way so that we keep everybody on the same track, we have created what we call models. So we have 6 models. Model 1 has 100% in bucket 1. Model 6 has about 85% in bucket 3. So you can see we can range anywhere between 1 to 6 based upon how much money somebody needs to distribute on an annual basis. So let me give you the example. I'm not going to go all the way up to model 6. I'm going to use a 1 and a 3 so you can see the variance. And then you can just let your imagination run wild with what a model 6 looks like. It's the same concept, right? So if I take a model 1, it has 100% allocated to bucket 1, the 0 to 5 year bucket, right? And the average rate of return that we target has been 4%. The average volatility rating, or VMS, we target is about 2%. Unfortunately, again, stressing, this will never beat inflation. So while you're sitting there going, wow, I could get 4% without the risk. Yeah, but you're still losing money. That's the key. You cannot make money in bucket 1. Now, if I go to, let's say, bucket number, let's use this example here. So if I throw all my assets into bucket 1, right, my anticipated rate of return is only 4%. However, you can see, even if I'm buying short-term bonds, there is going to be some, not a lot, fluctuation. So I can anticipate or target that this bucket will fluctuate about down to 980,000 up to 1,020,000, somewhere in that little range. Now you might say, well, if it still fluctuates, how am I going to make distributions? Because there's a lot of things in that bucket. There are money markets, there might be laddered CDs, there might be laddered annuities. Then you get to short-term bonds, which have some of the volatility. So as we grow in the volatility, so also does the potential for a rate of return. When we decrease volatility, we decrease the potential for rate of return. Now, risk is defined in many different ways. Some people will say, well, I don't want to risk my money in the market. Well, aren't you risking the money by putting it all into bucket 1 or a money market? Because you're risking it against inflation, so that's inflationary risk. There's risk of loss. And I would say if you buy single issue stocks or you do not use the right allocation and you get an emotional trigger to sell when things are down, you could lose. However, statistically and historically, between 10 years plus, your chance of physical loss, meaning your money has gone down in a well-diversified portfolio, is next to nil. It's when you buy single issue stocks. Oh, I'm going to buy this stock because I think this is going to do well. I'm going to buy Bitcoin. I'm going to buy gold. Yes, your chance of loss goes up. So when I say risk, I do not mean the risk of principal loss. What I'm talking about is volatility. Volatility is very different than risk of loss. Okay? So I want you to, if I happen to say risk, what I'm talking about is this up or down and somebody making a bad decision. Risk can also be inflationary risk. So if we look, even if this thing went up to 1,020,000, it's still not going to beat inflation. If it went down to 980,000, it's not going to beat inflation. Now let me give you the antithesis. Well, is that the opposite? No, it's not technically the opposite. I'm trying to find the right words here. A variation of bucket or of model 1. Okay, so here's what a model 3 will look like. If I have, now I'm just going to arbitrarily do this. I'm going to put 20% into bucket 1. I'm going to put 50% into bucket 2, and I'm going to put 30% into bucket 3. Now, that means out of that $1 million example, I'm going to allocate $200,000 to bucket 1. Now, why would I do this? Is it because I'm guessing on the stock market? No, 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 no. It's because we're reverse engineering cash flow. I'm going to put $500,000 into bucket number 2, the 5 to 10 year bucket, and I'm going to finally put $300,000 into bucket number 3. Again, the goal is to get that $300,000 to be worth at least $600,000 to $700,000 over a 10-year period of time. Now, this would also make the presumption that a client says, my number one goal is to maximize my cash flow over my lifetime. And the secondary goal is to leave money for kids or grandkids. Because if you run these numbers out, this system will last for 30 to 40 years. If a person said, well, I know I want to have more money for my kids, then you have to change the allocations between the buckets so that there's money left over. So let me show you what the outcomes are. If I look at the volatility in bucket number 1, if I allocated $200,000, it's going to fluctuate. The target is to fluctuate between 196 and 204. And in bucket number 2, the target is to fluctuate between 450 and 550, right? I'm using the top VMS rating, right? Because you'll see up top in bucket number 2, it has a normal volatility VMS rating between 5 and 10%. I'm just choosing the highest just to show you the highest variance, right? We know, and when we risk and we stress test, that's exactly what we do. We use the highest tolerance level so that we can measure the bad times, right? Because you want to make sure you got the life vests on the boat before you launch the boat, right? So if I go into bucket number 3 and I've got $300,000 allocated, I've got between $225,000 and $375,000 allocated. Now again, we're making the presumption here we're in distribution phase. Again, if you're in the accumulation phase, whole different math, right? Because you're working the opposite way. Here, I'm showing distributions having to come from left to right instead of from right to left. So let's look at what the average rate of returns are. So this is what people, sometimes they misunderstand. They'll say, well, I've got a portfolio and it has, it's going to go up, down by 20%. No, you can segment down what your average volatility and your average rate of return is, right? Because if I put 20% in bucket 1, I'm only going to get 4%. That's my average rate of return. But if I have another allocation to bucket 2, it's going to have its own allocation. And then finally, bucket number 3 will have its own allocation. Okay? And if I look and said, hey, what is that average volatility? Then, or average rate of return. So I've got bucket number 1 has 4% rate of return or $8,000 per year. Bucket number 2 has a 7% average rate of return that we're targeting or $35,000 a year. The bucket number 3, again, that's the 10-year bucket. Our goal is 12%. That's our target. We have $36,000 per year. So when we average it out and we weigh it out, we have an average rate of return of 7.9%. Now, here's volatility. Let's look at volatility because we don't have everything in one bucket. If I look at my average VMS, I got 20% times 2%. I got 50% times 10%. And I got 30% times 15%. Okay, so now if I look at this and say my average VMS is actually somewhere around 11.5. Now, there's going to be an upper or lower level. When we test cash flow, we're going to look at midline. Now we're going to go above that. We might say, what happens if our VMS goes to 18 to 20? Can we still support the cash flow that person needs? And so that's how we stress test things. And for those of you that have been through that exercise, so many of you have come back and said, oh my gosh, I wish my financial advisor before you guys would do this for me or would have done this for me. I'm not getting this kind of information. They're not telling me about this kind of stuff. And one of the reasons that we do this is I truly believe that financial institutions try to scare people into spending less money so they keep more money in their coffers. So while this may test your lower limit and your higher limit of volatility tolerance, I'm trying to get away from using risk tolerance, but volatility tolerance. You know what a lot of times is missed is the ability to figure out what the maximum amount is that you can spend. And I find more times than not, people are grossly underspending what they can because either A, they've never done this math or the exercise, or B, the financial advisor or advisory firm is trying to scare them into taking less than they could. So again, there's a lot of reasons to do this math, but again, I didn't want this thing to last hours today, and I could talk about this stuff all day long because I really think it helps people if they understand how to structure things. You can build a building of straw, or you can build a building of brick. Both of them require a foundation, but the brick building will stand up, and the straw building will get blown over every time the wind turns, i.e., the current stock market. So again, if you have not done this exercise with us, or if you're not with us and your financial advisor is not doing this exercise, let us do this exercise for you so you can see top end of volatility tolerance and bottom end, and then what is the maximum spend that you can afford. Okay, I'm going to do another video on dusting off annuities and end of year tax planning. So stay tuned for those. If you have not signed up on our YouTube channel, you'll see that in a second. And I'm going to give you some just real quick end of the broadcast suggestions. Do not sell stock into a dip. That is, you can tax swap. I'm not in disagreement with that. That's a good strategy, but do not sell and go to cash or try to time the market. Cash that's on the sidelines, annuities with no fees and high caps. I'll talk about that next time on the dusting off your annuities. Turn on the drip skip. We've done that for clients. If you attended my last broadcast, you can pick that up. It's called Market Volatility. It was on September 22nd. Use the piggyback call strategy. That is where you sell a call on up to a break even or a small profit on equities or bonds, indexes, that raises cash. And then what you can do is you can take some of that cash and you can buy call options on a much higher limit. So that may be a way of actually hedging an upside market without the risk that you're going to miss the market or that your stock would be sold at a loss. Okay, again, there's a couple rules here. Only used for bucket 3 and only perform after you do a deep dive on your cash flow and e-money. All right, before I wrap it up, if you've not become a subscriber, you can Google Wiser Retire on YouTube. You'll find this page. This site we're building out, and it's primarily used for those people in the accumulation phase. If you are in the distribution phase, you'll make sure you want to subscribe to the H&H Financial Center. And again, same thing, just YouTube, H&H Financial Center on YouTube, or Google, I should say. You'll get this page, hit that little red button in the top right, and it'll give you a subscription. That way you'll be notified of any future videos that I do. Sometimes I do them on Fridays, but sometimes I do one-offs for education, especially if there's major events going on. All right, with that in mind, enjoy the rest of your day. Hopefully this was educational, and join me back again for dusting off your annuities and end of the year tax planning in the future videos, but you got to subscribe so you're notified when I send them out. Have a great day.